Ladies and gentlemen, good day and welcome to Q4 and FY22 earnings conference call of Pennar Industries Limited, hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital. Thank you, and over to you, sir.
Thank you, Margaret. Good morning and very warm welcome to everyone. Thank you for being on the call of Pennar Industries Limited. We are happy to have with us the management of Pennar Industries here today for question and answer session with the investment community. The management is represented by Mr. Aditya Rao, Vice Chairman and Managing Director, Mr. Shrikant Bakhar, Vice President Finance, Mr. J. Krishna Prasad, Chief Financial Officer, and Mr. Manoj, Head Corporate Affairs, and K.M. Sunil. Before we start with the question and answer session, we'll have opening comments from the management. Now I hand over the call to Mr. Aditya for his opening comments. Over to you, sir.
Thank you, Vikram. Before I start off, there's a lot of static on the line. I hope what I'm saying is audible. Could you confirm that it's audible and there's no static? I'm not sure if it's on our end or your end.
We can hear the static, sir, but your audio is also audible. So if in case it gets worse, we will let you know.
Okay. Please feel free to interrupt anytime I'm not legible or audible. Thank you very much.
Sure.
Firstly, thank you to the moderators, to all our stakeholders. I welcome them to our Q4 and financial year 2022 financial results conference call. Thank you for joining us, and I hope you and your families are all safe. Our standard format for our conference calls is the following. I will first address us on the company's financial performance for the quarter and for the financial year. I will provide an analysis of our performance and what we expect in the coming quarters. As has been the case for the past few quarters, my focus on profitability, liquidity, and growth. Post my address to you, our CFOs, Mr. Shrikant Bakhar and Mr. Krishna Prasad, will present their analysis of the numbers, their commentary on our performance for the quarter and for the financial year. So with that, I'll get started. For my initial comments, for the financial year ending March 31st, 2022, we recorded consolidated net sales of 2,266 crores. For the fourth quarter of this financial year, we had recorded consolidated net sales of INR 692 crores. A consolidated PAT for the financial year was INR 42 crores, and the consolidated PAT for the fourth quarter was INR 16.7 crores. We also generated a cash PAT on a consolidated basis of INR 96 crores, and our cash PAT for the fourth quarter was 31.7 crores. This represents very high growth in our PAT for the financial year due to the previous year being a pandemic year, so they may or may not be comparable. Furthermore, the fourth quarter last year had a special item, namely the sale of our land asset, and as I mentioned on my last conference call, if we are comparing quarter growth, we should take that into account. If we account for the land sale and other one-time items we recorded, growth in our PAT also on a quarter-on-quarter basis of about 20%. Now on a sequential quarter basis, which is Q3 of the last financial year to Q3 of the financial year 2022 to Q4 of the financial year ending March 2022, we recorded PAT growth of about 56.1%. On my last call, we had given the following guidances as management. We promised double-digit growth in PBT from Q3 to Q4. We promised working capital days reduction from around 100 days to 90 days. And we committed that we would commission our BIW project in Chennai and achieve our target PBT. I'm glad to report that we have achieved or exceeded all of these projections. And for the next quarter, we again expect PBT to have strong growth of at least double digits. That's quarter on quarter, Q1 last year to Q1 this year. And we will further seek to improve our working capital usage from where it is right now, which is around 80 days, correct me if I'm wrong, Shrikant, to around 75 days over the next 2 quarters. On growth, we will further improve our BIW plans, capacity, revenue, and profitability, and the overall company's PBT percentage further. Our goal will be to achieve and maintain a ROCE of 20% for the financial year. Our growth vectors now currently are, as I said, BIW capacity expansion, our Ascent, our subsidiary in the US, Ascent, their capacity expansion, and our module plant capacity expansions. Once commissioned, these projects will strongly contribute to our PBT growth for this financial year and for the next financial year. In conclusion, I must take the time to thank all of you for your support in the past few quarters. We've embarked on a new journey post the pandemic with a vision of evolving into a strong engineering company, which through our manufacturing and engineering design solutions, we enable our customers to boost their productivity and their growth. We will continue to focus on sustainable revenue and profitability growth, liquidity and capital efficiency as our guidelines as we implement our growth plans. Thank you, and I hand over the line to our CFOs for their analysis.
Thanks, Aditya. Just to take you through the key metrics that we review every time for ourselves. These are in terms of revenue, where it has gone up from the last financial year, FY21 to 22, from 1,525 to 2,265 crores, which is 48% increase. In terms of PBT, from 3.65 crores, where it was, to 55.9 crores. Similarly, in terms of EBITDA, 131.49 to 148.49, and in terms of cash, PAT from 51 crores to 95.75 crores. So these are the overall key metrics that we do for ourselves in each of these quarters. Taking you to the detailed analysis on each of those numbers. The net sales, as I said, has increased by 48.5%, but whereas if you come to the other incomes are predominantly on account of the treasury that we have and then the write-backs that are appearing there. The raw material, the costs, which is generally called, the raw material is at 61.86% in terms of the net sales, and while compared to the earlier quarter, it is 60.31. So overall, 150 basis points, there was an increase in terms of the cost there. This is due to the increased revenue and certain margin-related things. Benefits cost has gone up. We have back to normalcy, and all the employees and costs of the things we started paying off. The finance cost is the next line item that you see. The finance cost, even though with the increase in the revenue from 1,525 crores to 2,265 crores, we were able to maintain the similar finance cost. This keeps up the point that we are able to improve our working capital in terms of number of days as well as in terms of the value-wise. Depreciation, more or less, it stays flat. The increase that you see is on account of the capitalization of the Ascent subsidiary in US. In terms of overall PBT, there has been increase from 3.65 to 55.9%. Just to take you through a couple of balance sheet numbers, though the detailed balance sheet is available at your end, I just would like to glance on the certain aspects. If you see the net investments and the cash and cash equivalents that we have, we are at 120 crores. We are sitting in terms of these amounts. Trade receivables, again, is one of the items wherein it has remained flat. Even with the increase in the revenue, the trade receivables have reduced, which indicates that we were able to collect more the earlier amounts, whatever were there, and shows a better picture in terms of our accounts receivable. Inventories have increased for the revenue that we are doing or will be doing in the coming quarter. The revenue has slightly increased when compared to the earlier quarter. In terms of borrowings, we were able to reduce our term lending from 112 crores to 98 crores. Payments of close to around 14 crores. Trade payables, we are able to, because of the increased confidence that we are able to give, we are having now better negotiate with our lenders.
Sorry to interrupt you, sir. At the moment, the static is quite loud, actually. So let me connect you on the alternate number, if that's okay. I would request participants to please stay connected. Ladies and gentlemen, thank you for patiently waiting. We have the management on the line with us. You may go ahead, sir.
Yeah. This is in terms of borrowings where we were, where I've stopped. So borrowings has decreased from 112 crores to 98 crores. There is a decrease of 14 crores in terms of long-term borrowings. While we compare the gross borrowings, they are at a flat level, even with the increased revenue that we have. We were able to negotiate better, and the trade payables have increased from 442 to 543 crores. Just taking another few details for your detailed analysis. The cash flow from operating activities have increased for the current year, March 22, is close to around 200 crores. PBT comprised of 56, depreciation comprised of 54, and the working capital, operating changes in the working capital gets us additional 100 crores. This close to around 200 crores have been deployed in terms of fixed deposits and mutual fund close to around 55 crores. And the PPE in investing activities, 57 crores. The amount has also been used in financing these activities. The interest is close to 78, and there's a reduction in terms of term loan, 16 crores. So overall, this quarter has been better from the earlier quarters in terms of top line and in terms of increasing our better working capital. Couple of points, as I said. One, that you see on the capex, the BIW capitalization will come into in this quarter, and this capex will result in further growth of the company. With this, I hand over back to the moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nilesh Shah from Arrow Investments. Please go ahead.
Yeah, hi. Good morning to the team at Pennar Industries, to Aditya, Shrikantji and Prasadji. Congratulations on a wonderful quarter. And am I audible again? There's no static here. Am I audible? Hello? Hello? Hello, am I audible?
Yes, you're audible, sir. I would request you to go ahead, please.
All right. So just one point I have a couple of questions. So the first thing I want to just highlight is in the audited results that you have shared yesterday on the exchange, there is a point number 4 where you have bought equity shares of 50. I think there may be an error over there. 50 equity shares at 32 lakh rupees, including transaction cost and tax on buyback. It's only 50 equity shares up to March 31st. So can you please clarify on that?
See, this initial, I'm Shrikant here, I'm just clarifying. These are the numbers that are one-time stock exchange fees that we have paid to both the exchanges and close to and the SEBI fees that we'll have to pay mandatory before we stock off, and some of the bankers who are arranging those fees are there. The cost of the investment is not that high. So they are one-time cost which is appearing. That's the reason the amount is 32 lakhs included there.
Okay, so 32 lakhs includes the transaction and SEBI fees on the buyback that we are going on, which is currently on.
SEBI and stock exchanges. SEBI fees of around 22 lakhs and stock exchanges fees of approximately 5.9 each.
All right. Okay, perfect. I understand. All right. The second thing I had to clarify was the total borrowing of the company is around approximately 645 crore. Is that correct?
580.
For total borrowings, including your other financial liabilities, I think will be 645 crores.
After the Schedule 3 revision, the other liabilities are now included in short-term borrowing. So the total short-term as well as the long-term put together is 587.
587. All right. And our interest payment to that is 78 crores.
75. Yeah, 78.38 crores, correct.
Yeah, 78.38 crores. So what is the rate? Because I was going through the last year's audited report and most of the rates are around 10%, 9% to 10%. So why are we actually having such a high interest outflow compared to the total borrowings?
To explain you this, I think there is the LCs and the bill discounting that we do.
those costs also get added. It's not necessarily the short-term and the long-term borrowing costs which gets replicated. And there are, apart from this, we give bank guarantees also, close to around 150 crores of bank guarantees also have been given, and the vendor bill discounting that we do with each of those vendors. So those costs also gets added.
Okay, so all those costs put together, but our average cost of finance is? The average interest that we are paying? 8.5%. So if I have to look at 8.5 even on 580 crores or whatever, this is little substantially very high, the finance cost. I mean, I just wanted to clarify as to why it is above 15%, nearly 14 to 15% of a total. So maybe like you said, the lease liabilities and LCs and the discounting, I think that is affecting the costs of finance. Yeah, all right. Is there any way we are going to bring this down in the coming quarter as our working capital gets more better and efficient?
If you would have seen, even with the increased revenue that we had with from 1,500 to 2,265, we were not able to increase the finance cost.
I didn't get you, sir. You're not able to increase the finance cost. So it's not gone up, you mean to say?
Yeah, it has not gone up, and from earlier it was 3.76% of our total net turnover. Our plan is to reduce this to 3.3% in the short term, and 3% is what we would want to stay. Yeah. So interest cost as a percentage of sales will be around 3 to 3.5%.
Will come to 3.5. All right. Yeah. Okay, fine. Thank you for clarifying. And one more question is on the net profit margin in quarter 4. It declined to only 2.4% from 5.9 quarter on quarter. So I don't know why the reason. In spite of an additional sales that we did comparatively, our net profit margin is only 2.4 for the quarter, and for the overall year we are at only 1.8%. I mean, it's just kind of very surprising to see that we are working at such low net profit margins. So can you give little color and clarify on that? From 5.9 we have dropped to 2.4. The corresponding quarter in March, yeah.
I just, if you have comparing the sequential quarter with the sequential quarter, there was a one-time exceptional item of 19.96 crores, which was sale of land. And apart from that, we also had some tooling revenue, which was there in March 2021. So if you remove that one-time profit and
one-time profit of 19 crores from the sale of land.
Yeah, that was there in the last quarter. If you compare with March 21 to March 22, if you take out those exceptional item in terms of the tooling revenue, which is included as part of our normal income, post this removal, this number will be better.
All right, but our
EBITDA is actually increased.
Okay, no, our EBITDA is around 8.5%, but our net margins are coming to less than 2%, for the year. I think the management should little bit work on getting the net margins up, I don't know how to explain this, but I think it's a very, very low margin compared to the overall turnover that we do. And in terms of costs also, I've just gone through it. So there is one employee benefit expense which has gone up to 208 crores from 136 crores year on year. I don't know why there has been a 50% jump in the manpower cost or the labor employee benefit expenses. So you can just, that will be one of the last questions, please.
Yeah, so let me unpack what you're saying. First, you're saying that our PBT is low. I agree, and we're working on increasing it, and you will definitely see increases in the future. A lot of this has to do with a very high depreciation also for us. If you look at our cash profit, it's a PBDT, for example, it's substantially higher at around. So you will see this number go up. I agree with you that a company our size, the capital we are using, we should have higher PBT percentages, and we can commit as management increasing them. As per cost of the employee cost expense increases, that is because of our increase in our employment in the US for Ascent. They started operations late in the financial year, in this current financial year, FY22 late, they started operations. They're doing very well, they're scaled up, but we can't treat that as pre-operative expenses. All of those have to be expensed out. That's why our employee cost is higher. We, as the management, can definitely commit to you that PBT percentage, PBT value, our ROS, and quite frankly, our employee cost as a percentage of our sales, all will improve and remain within boundaries, within guidelines. Thanks.
Okay, fine. Sorry, sir, just one more last thing that like you just mentioned that we have this Ascent Buildings, which is now a subsidiary in the US, which is doing well. There is an export duty which has come in the last week, 15% on steel, which is going. So how are we going to mitigate the impact of this excess export duty? Will we be able to pass these costs on to the customers there in the US?
In terms of we dispatching from here for the purpose of Ascent, there is nothing. Ascent manufactures, has a plant in US at Tennessee. They manufacture in US and they sell to the US customer.
Okay. So there is no 15% export duty impact to us. There is no impact of export duty of 15% on our sales to US.
Yeah.
All right. So thank you so much for clarifying. I may have further questions. I'll rejoin the queue. Thank you.
Sure.
Thank you. Ladies and gentlemen. Yes, sir.
Hello. Can you call the landline once again because it seems to be rectified now.
All right. Ladies and gentlemen, request you to continue to hold while we reconnect the management. Thank you. Ladies and gentlemen, thank you for patiently waiting. We would also like to remind participants, if you wish to ask a question, please press star and 1. The next question is from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
Yeah, sir, can you give some idea about how are the order situation in different segments, particularly PEBS and other segments also, and outlook on that individual segment? And we have seen strong growth in projects also. So we have led this growth in projects and some comments on how is the revenue in engineering services also. So these were some questions.
So let me make sure I've understood all the questions, sir. One is on order books for our business divisions. The second is you're asked for an outlook on engineering services.
Yeah, and projects also, what has led this strong growth within projects also, if you can give some idea about growth level.
Could you say that again? Your voice is not clear, sir. I apologize. But could you repeat that last part?
Yeah, project segment has also reported a strong growth this quarter.
Yeah, okay. So, be as clear as I can. I hope my voice is clear and my answers are clear. Let me go on and for railways order book has stayed static at around 100 crores. Our order book for Ascent has increased dramatically to where right now we are sitting on close to $40 million in order book, and quite honestly we can increase it to 50 also. We are being very picky with the orders we are choosing. Railways order book, our PEB order book in India is quite strong. It has increased to about 500 crores in the last quarter, and our order book for solar also is steady. Engineering services has done well. Both our structural engineering and our automotive and plant engineering services verticals have scaled up well, and the fourth quarter is much stronger than the third quarter, and we expect this growth trend to continue. So we are quite happy with the performance of these business verticals.
And projects business, within that, how you are seeing the traction in within different parts of projects business?
Sorry, projects business versus? What was the question?
The project business, the growth is more led by PEB or solar or enviro, or how is that?
So projects business is Ascent and PEB primarily, also railways, but it's right now dominated by Ascent and PEB from our revenue value size.
Understood. That was it. Yeah. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah, hi. First of all, congratulations, Aditya, for, I think, ticking pretty much all the boxes that we started 2 years back. Good set of results. My question is, if I compare the gross margin, the margin of engineered products versus, pre-engineered building project business, the margin of pre-engineered building has come from 9.5% from Q4 last year to 6.5% this year. My understanding was that whereas for products it has come down from 9.5% to 8.5% this year over last year. My understanding was that the pre-designed engineering products margin will remain same or go up, considering the extent contribution. It hasn't happened. I can understand the raw material impact as well as the employee cost impact, but if you can give me some more light on how the trajectory of gross margin for pre-designed engineering building going to be from current 6.5% for next 4 to 8 quarters. That's question number 1. The question number 2 is about the news article that came up today of railways placing order of 7,500 crores on Titagarh wagon. Is it good news to us, bad news to us? Does it mean that we'll get a contribution from here? Are they our customers, or is the railway pipeline opening up? That's the second question. The third question is about this, body in white. I understand we have complete order book for the capacity. So if you can tell us, you are going to capitalize this year, this quarter. How is the ramp up going to happen over next 2-3 quarters? Are we going to get to a full capacity by how fast it will happen? So these are 3 questions. The fourth one is about this acquisition in France that I read, I think, in your PPT. What is it? I think we had some discussions 2 quarters back, but has anything fructified because you've given it in the presentation? Yeah, these are the 4 questions.
Thank you, sir. I'll go one by one. The margin profile for our pre-engineered buildings division will continue to scale up. Post the pandemic, we've taken our time to structure that business's growth well. It has been, while fixed capital formation picked up, I think we've been a little circumspect on taking orders on that. That time has now passed. Our order books are strong and good, and I can assure you that our EBITDA and our PBT for our custom design building solutions business will continue to scale up over the next few quarters. Q1 will be better than Q4, and obviously the average of this year will be much better than average of last year. So that I can commit to. Wagon orders for Pennar, we are expecting some to come in right now. Titagarh would be one of our customers. What we make are wagon assemblies and CRF sections. If we get orders from them, then we can. But right now we are optimistic. But as of right now, I have nothing to commit or say that this is our wagon order book for railways. We are still quoting on orders and hoping to get some good news on that. BIW, as I had mentioned and as Srikanth had given you some clarity, we expect about 100 crores in revenue in this financial year from that business, and that will be at a high, almost 7% PBT. So that's the profile in terms of what we expect for this financial year. We'll increase capacity and then try to boost that further. But that as of right now, we're currently at a run rate of about 9 crores. So I don't believe we are overcommitting. This month we should be doing around that much. Cadnam, which is in France, is in the business of providing automotive and aerospace products, high precision. We will be acquiring them. Hopefully that acquisition will be completed in the next few weeks. We have submitted our agreement to the French courts. Everyone has agreed. We expect to start recording revenue of Cadnam in our financials from the next month. And we have high hopes for that business. It would be perhaps not right for me to project revenue profitability from that business right now. But what I can guide to is that we're in advanced stages of completing the acquisition and starting revenue. In Q1 of this financial year, we'll start recording revenue. And it's a profitable entity, positive cash flow generating entity. And once we have done our homework, we will project our plans for that business. I think those are your 4 questions, sir.
Yeah, thank you. Thanks. And if I may ask, one last question. Our employee cost, since I think, you are saying that we are now choosing the orders from extent, which means that we must be getting into a steady state. Can I assume that this employee cost is going to be stable and will not, even though the revenue goes up?
I can commit to it being stable, with potentially some moderation also possible, but I can commit to no large increases in this. I would not even say 10% growth on that is on the cards. So around that number is what you should expect.
Yeah. Thank you very much. In all of it.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is a follow-up from the line of Nilesh Shah from Arrow Investments. Please go ahead.
Yeah. Hi again. Just one clarification again on this Build 360 retail stores that we were opening up. We had opened around 7 to 8 stores over the last couple of years. Are we in that mode to open more stores across India or the franchisee route, or are we actually not giving that business so much importance?
No, we are not. I would be honest. That is one of the ventures we tried. We try as managers, as entrepreneurs, as leaders, we try something. Sometimes they work out well. We're holding it static at 8 stores, sir, and we have no plans now to expand that business. We don't believe it to be, we have not been able to achieve the success we thought we would have in Build 360.
So we are probably keeping it static and winding it down. That's what I mean, last conference call you had mentioned that you would like to come out of non-core businesses as well. So I think, pardon me?
Yeah, right now also it's not, there's not a lot of capital in that business, but as you have said, we will not be growing that business.
All right. Okay. And just again on the BIW, the body in white thing, can you give us a little color on the kind of customers we are working with?
Stellantis is a major customer. We're also trying to work with other auto majors. Since there's, I'm not sure they would be okay with me revealing their name. Stellantis, I'm sure there's no issue, but other auto OEMs, I can say.
So we don't directly deal with auto OEMs, basically, like Mahindra or the Tatas or Hyundai or any one of that type.
Stellantis is a $70 billion global. They hold brands such as Jeep and Citroën and Peugeot and others, and they're one of the largest automotive OEMs in the world. Number 3 or number 4 to my knowledge.
So you had mentioned that looking at an order book of around 100 crores for the year, I mean doing business of 100 crores with a margin of around 7%. Correct?
Revenue, not order booking, but revenue. Orders are already inside. We have the orders in to do that.
All right, fine. Yeah, I think, yes, okay, last question is again on the land sale that we had last year. We monetized around 19 crores. Is there any plans for any additional land sale that we may have for this year or coming years that the company is looking to monetize?
Right now, I have nothing to share on that, sir. That would be the right way to put things. I can say that the company has very substantial land assets. We sold 5 acres. We have, I would say we have hundreds of acres. But I think at this point, I can't comment on any plans. The board holds all kinds of discussions on this, but right now we have nothing to communicate.
Okay, fine. I think I had just one more last question if it's okay. It is on the buyback that is going on currently. I think there's a buyback that is in progress and the company has been aggressively buying the stock from the open market. And just wanted to check the reasons why the company went in for a buyback, because we could have actually reduced our debt and liabilities by repaying this 40 crores towards reducing and profiting from our interest costs. So I understand you're trying to enhance shareholder value, but wouldn't it be better to repay back some of the debt and try to mitigate our interest expense? Because interest rates are on the rise upwards and we are working with just hardly 2% margins. So if there is a substantial rate hike, we would again have a negative impact on our balance sheet and profitability.
So I think the decision to go for a buyback is predicated on a couple of things. First, you're right that 2% is our PAT margin, but if you were to look at a cash PAT, you would find it to be different also, and that is the amount of cash the company generates. More importantly, our interest costs overall have not actually risen by a substantial amount. They may have, in fact, declined a little bit. They've actually declined a little bit. So and also our debt equity is not very high at 0.7 or 0.8. So I don't see that as at least that's our opinion. Some of these can be subjective calls. I think what's important for us is if we're doing a buyback at a forward EPS times PE multiple. So the PE multiple right now we're at it is at 8. So if we're doing a buyback at 7, 8, I think that is a worthwhile use of capital as well, provided we're not losing out on revenue on that. The opportunity cost of interest cost reductions would be less. That is my view. If you're compromising on the revenue or business which you can do, then because our ROS is much higher than our potential capital cost, that's one reason. But all of these are judgment calls that we have to make. In our judgment, since our EPS growth is on a steady track, and I think you can hold me accountable for what I'm saying. At least last 4, 5, 6 quarters since the pandemic time, we've revamped the way we do these things, and I think you can hold me accountable for everything that's coming out of my mouth.
No, so our ROS is basically around 10%. I think as of after updated yesterday's results, it's come to close to 10%, 9.97 exactly. In fact, the ROCE. So there's a conscious effort to actually take it up to around 15 or 20%. That's what we are trying to imply by this.
Our ROS should be 15%, and if you look at our fourth quarter and annualize that, then it's even higher than that. But anyway, we can discuss that. These are statements of fact; they can't be debated. So we'll send our calculation. You can send us yours. Okay. I think a buyback is a good use of our money personally, but the board has looked at all angles, and we believe that we should make sure the company is on a firm growth path. We should make sure we have liquidity. We should make sure that if there's an opportunity at a low PE multiple, then reducing the equity of the company is a good option. That's the rationale.
Okay. And just to add up to the follow-up question by another investor just prior, the company is in talks to acquire an engineering and precision-based company out of France, the Cagnum thing. What is the kind of capex we are looking at for that?
It's very low, sir. I think only about 2 crores is the cash outflow we have right now.
All right. Okay. So I don't know whether it will make a substantial impact on the kind of revenue and sales or profitability of the company, the acquisition.
Once the acquisition is done, sir, we'll give you detailed plans. But if I can, without numbers, if I can give you an idea, the idea is we did exactly this in the US, and we acquired a company, then scaled it up. That is the rationale behind this. It opens up the Europe market for us. If we replicate everything we're doing in India, in the US, and in Europe, those markets there are massive, and it will allow us to substantially scale our revenue and profitability. But it would be premature right now for us to say that Cagnum will allow us to do that. If you're saying, look, it's too small right now, feel free to not pay that much attention to it. Once we have our plans in place, we'll come back to you and tell you exactly what we intend to do with that. But it's a step.
So it was just in the overall scheme of things. When we do 2,000 crores turnover, an acquisition of 2 crores doesn't make a meaningful, I don't know, right now maybe it may not, but as you said, going ahead, it may make a meaningful difference to our top line and bottom line.
We started PGI 4 years ago. We put barely any capital into it as well. And this fiscal, it will do about 70 to 80 million in revenue. So these things are subjective, sir. I suggest we give it the time it needs, let it cook. And everything
fingers crossed, Aditya, we're looking forward. And large investors actually like Saif, Franklin, DSP and all over the last 1 year have actually exited these businesses. I don't know why. Saif was an investor for more than 10 years. And we acquired an investment in our company, and obviously I think they were pained with that investment and they exited at a loss. So I was just trying to figure out the logic as to why they would exit at 21 rupees when they bought in at 42 and waited for 10 full years. So somewhere I think company needs to take, this is just a suggestion, the company needs to take a conscious effort to get in quality investors on board and kind of have more of investor interaction so that investors are more comfortable with their investments in the company. Because all the big larger players have actually exited our company as an investment, and we need to get some quality investors back in the business.
Point taken, sir. I don't have an argument with anything you said. Everything you said is a statement of fact. We'll work to, I think the best way I can serve my investors and we as a management of the company can serve our investors is to keep improving in terms of profitability, liquidity, capital efficiency, and the results will come. As to SEVs, I have a lot of respect for them. I think they're a great fund. As to the specific reasons for leaving, I can't speak to that. I mean, they have their own way of making decisions.
Fine, sir. Best wishes for the year and forthcoming quarters. Thank you so much.
Thank you. Thanks so much.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is a follow-up from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah, thanks. Two questions. One is regarding the investment for next 3 years, and if there is any further investment required in Accent as well as the railway capex we did, I think, around a year and a half to 3 years back. Is it complete or is it ongoing? So if you can tell us, that's one.
Finalized our capex plans for the year, sir. So at this point, we will be unable to communicate what our capex outlay for the year is, but we don't intend to increase our debt profile or anything. So whatever we'll eat what we kill. So what free cash flow we generate, we'll use that.
Sure. Yeah, sure. So that leads to the second question, that if you are having 100 odd crores of cash profit, and I'm sure it will go up as the margins goes up, you'll have 400-500 crores of cash in next 3 years. So what is the direction? Is it debt reduction or is it buybacks or is it dividend? So that's question number one. The second question was regarding the services business. If I remember, when we acquired the company, I think BIMS Online or something, the revenue was around 2.5-3 crores. We are doing, I think, 5 crores now after 3.5 years. I understand that there has been some realignment, but is this going to be a substantial portion of our total revenue? What is the plan for it? Yeah.
Sorry, I just wanted to understand your specific. Are you talking about our BI, building information modeling acquisition, which we had made, and the revenue from that? Is that what you're asking?
Yeah, you sold some 5 crores of revenue and in the PPT, which is very small compared to a 2,500 kind of revenue. So my question is the services business is going to be a mover for our revenues and bottom line?
So in my view, I see the future of Pennar as being precision engineering and precision design as well. So our entire design engineering work that we do right now would on a per year basis reach about structural engineering to about 50 crores. And the PBDT on that would be about 20%. Well, PBT, there's no depreciation really in those things. So I believe that this is a business we should scale up. I believe this is a business we should do better in. And it ties in well with what do we engineer, right? We engineer BIW automotive components, which lines into our BIW manufacturing. We engineer buildings, which gets into our pre-engineered buildings range as well. We engineer plant engineering and other systems as well, which we don't have a manufacturing component for that. But these are good industries to be in. They're large market sizes, and we can consistently over time grow these businesses. So I'm quite happy with the progress they're making, and I'm quite sure that if this year we are at a 50 crore run rate, it will start contributing quite significantly to our bottom line. There's a reason I say that I'm aggressive about our PBT. There's a reason I'm saying that next year we'll have our highest ever PBT. I committed that in the last few conference calls. So on everything we will make progress. Tell us where the issues are, we'll focus on them. But largely the story I want to tell you is engineering services, precision manufacturing, high margin businesses, higher PBT, good ROS. There are targets and we'll get closer and closer to them. That's our intent.
Yeah, that's absolutely clear. My question was about the growth, Aditya. 30 crores to 50 crores in 4 years or 3 years is there some focus in terms of leadership team and and sales, or is it just riding on the existing sales team of a project business?
Okay. Sorry, I thought I understood your question differently. You're asking, sir, about the growth rate for that vertical?
Correct.
It will be quite high. I would project double-digit growth rates for that vertical in this financial year compared to last FY23 versus FY22, double-digit growth.
Okay, fine. And the capital allocation, considering that we don't have any major investment plan.
Could you well, I think, as I said, we have plans to increase our BIW capacity, our module capacity, and also Ascent will go into phase 2, which is their growth plan. So, but we will do this with the limits that we have. We're not going to allow a massive increase in our debt or anything like that, is what I'm trying to say.
Okay, thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you. Thank you for the questions. We have taken note of everything that you have said on the factors you want us to improve on, and we will make sure that we make consistent progress on that. My takeaways for the call are to keep monitoring the PBT percentage, make sure that an increase is going to happen, improve our cash generation further, and also give more clarity on some of the bets we are making in terms of our Cadnam acquisition and others. But thank you for the questions, and thank you for your feedback and candor source.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.